All right, so let's go over one of the ways that backtesting can be deceiving. A 90% win rate sounds like the dream, right? If you saw that over 2 years of backtested data, you'd probably assume the strategy was extremely robust. But this is where the story gets dangerous. The trader takes that strategy live with a lot of confidence, and then the performance collapses. 3 months later, that 90% win rate is down around 40%. The important point is that the backtest wasn't necessarily fake or manipulated. The problem was something much more subtle. The strategy was overfit, as they call it, to the historical data. Overfitting means the strategy has been optimized so precisely to the data that it starts memorizing the specific chart instead of identifying a repeatable market behavior. The goal of a strategy should be to capture something that can happen again, not to perfectly explain what already happened. Think about the difference between these two outcomes. One strategy is capturing a real, repeatable behavior in the market. The other has essentially memorized the historical sequence. The second one can look incredible in a backtest, I should say. But that performance may disappear the moment the market gives it something it hasn't seen before. This is why overfitting can be so deceptive. You can keep adding filters, changing settings, adjusting entries, and tweaking exits until the historical results look almost perfect. But every additional optimization gives the strategy another opportunity to fit the noise in that particular data set. And then the market changes. Volatility shifts, market conditions change, and the exact pattern the strategy memorized doesn't repeat in exactly the same way. That's when the difference between a genuinely robust edge and an overfit strategy become obvious. One way to diagnose the problem is to look at how the strategy performs across different conditions. If a strategy only works under one very specific set of historical circumstances, that's a warning sign. A real edge should have some consistency, even when the market isn't behaving exactly like the training data. The answer isn't to stop backtesting. Backtesting is incredibly useful when you do it correctly. The real issue is using the same data to both build and prove the strategy. If you optimize and evaluate on the exact same historical period, you're giving the strategy a chance to learn the answers to its own test. So test correctly by splitting your data. You want a development period where you build and refine the strategy, and then a separate period that remains untouched. That second period is where you find out whether the strategy actually generalizes. The key is to keep those environments separate. The first data set is where you develop the strategy. The second data set is effectively locked away until you're ready to test. That prevents you from unconsciously changing the rules every time you see an unfavorable result. Phase one is where you build the strategy on one isolated portion of the historical data. Optimize your rules there, but understand that the results are still only evidence from the environment you used to build the strategy. Phase two is the important reality check. Take the finalized strategy and run it on a completely separate period that it has never seen. Don't change the rules because you don't like the results. The whole point is to see whether the edge survives outside the data it was built on. This is the uncompromising moment. If the out-of-sample performance falls apart, that's information you need. It means the strategy's impressive historical performance was likely tied too closely to the original dataset. If the edge survives, you have a much stronger evidence that you're dealing with something potentially repeatable. This is the paradox of perfection. The more perfect a backtest looks, the more skeptical you should become. An almost flawless result can be a sign that you've optimized away the randomness instead of discovering a durable market behavior. Real markets are messy, so real strategies usually are too. That's the final takeaway. A backtest that's too perfect isn't proof of a great strategy. It's often proof that the strategy has memorized the past. The goal isn't to build a strategy that wins perfectly on yesterday's charts, because how many of those do we get to trade? None. The goal is to build one that still has an edge when the market gives you tomorrow's chart. All right, traders, reach out with any questions and trade well.